The euro barely budged on Friday, even if we saw the 10-year BTP yield jump 27 basis points. For you trading euro-dollar, what is the point where you actually start to want to take trades on that cross based on Italy?
Half the job of a foreign exchange strategist is just knowing what the next driving factor will be. There was a time where the BTP bund spread was everything. And now it's more about the ECB versus the Federal Reserve in the US. Who can out-ease who? And we're going to see quantitative easing, we're going to see rate cuts again. So that's from the ECB side. And then the US is cutting rates anyway. So we've got this war of easing, the race to the bottom. But I think the pressure will be on euro-dollar, because if I look at the two economies, which one needs a weaker currency more than the other, it is the euro area versus the US, which is less exposed to foreign headwinds, let's just say that. So when it comes to euro and the BTP bund spread, this will matter when those elections have a date, because we'll have to then hedge our currency risk. So when we get a date, you'll see FX options start to price in a higher risk premium. Let's say it's sometime in late October, around the same time as Brexit as well. This is going to be a risk-off move. If you see this, the League partner up with someone like the Brothers of Italy, far right ring, if you have a coalition like that, the euro won't be able to go higher.
Why? So you see pressure on euro versus dollar. I'm looking at euro versus pound, Jordan, and I've taken a long view here, going back to, well, to be honest, before the euro actually existed, but it was still a concept. Why is euro pound climbing back up to levels that we haven't seen since the financial crisis, really back up towards a record high?
Well, because you put a long-term chart up, the UK has a higher inflation rate on average than the Eurozone. So over time, the euro gets stronger versus the pound because the inflation in the UK erodes sterling's value. That's the long-term trend that you're plotting there. But when it comes to the more short-term recent moves, it is because the probability of a no-deal Brexit has gone higher. It is because the UK is suffering more, even more than the Eurozone when it comes to the growth data. And if anything, the data suggests the Bank of England should be looking to cut interest rates, not raise them. The inflation in the UK is what stops them from doing such a thing. So we have high inflation expectations, and current inflation is at target. So again, eroding the value of the pound, real yields in the UK are going lower and making historical lows. So we're actually currently long the euro, short the pound, looking for the high in that chart that you've got there, somewhere between 93.50 and 94. And if we continue to see no-deal Brexit preparations, it's just going to go higher and higher until Parliament acts and stops a no-deal Brexit.
So that's euro-sterling, Jordan. But if we look at cable, we closed at the lowest since the 1980s on Friday. Some are calling for parity in cable. I know that's not your base case, but what could take us there and by when?
Look, we've done the numbers, we've done the homework. You can get to parity if you imagine a world where on day one of Brexit, you just can't trade with European counterparts. If I'm at my desk and I'm looking at my screens and I have no idea if legally I'm allowed to trade with my German, my Swedish, my Dutch clients, that is a scenario where you can get to parity in the dollar versus the pound. So therefore, when it comes to the... Sorry, Matt, go ahead.
Well, I was going to say, I don't recall ever being there. We've gotten close, right, with Soros, and we just never actually have gotten there.
So you can get there because the current account deficit is still wide in the UK. So just looking at the way we model it, it's called what we call the fear analysis. So it's where the pound has to devalue to make the current account deficit that the UK currently has tip into a surplus. Just think like Turkey, where they had a current account deficit and it went into a surplus after the devaluation. We'd be looking for a similar thing with the pound and the UK.